Hi guys, welcome to the first video on Simply Invest. I'm YJ and today, I am sharing with you a simple way to analyze a stock in less than 40 minutes. We will be looking at what I call 7F. These are the 7 factors I look at and analyze when deciding about a stock. At the end of this video, you should be able to analyze the stock by yourself using the 7F and make your own decision on whether to buy, sell or hold a stock. The 7F should let you be about 80% confident in your decision, whereas the last 20% should come from further research about the stock from news articles, company reports, etc. But before diving into the 7F, I would like to talk about value. In life, different people may value the same object at different prices. For example, in an auction house, for the same diamond, different people will be willing to pay a different price for the diamond. The same applies to the stock market. The price that a person is willing to pay for the same stock vary from people to people. The reason is because different people have different objectives in the stock market. Some investors try to follow the momentum of the stock to try to earn quick profit. And some investors invest by evaluating the financial position of the company to ensure that the stock would be a good long-term investment. Different valuation method used by different investors will also result in the varying price one is willing to pay for a stock. A person who assumes that a company will grow quicker will generally be willing to pay more for the stock. For example, a person who assumes that the company will grow at a rate of 30% per year would be willing to pay a higher price for a stock, as compared to another person who assumes that the company will grow at a rate of 5% per year. Different expected return of different people would also affect the price that one is willing to pay for a stock. Taking for example a stock that is estimated to be priced at $100 in 1 year time. A person with expected return of 5% per year would be willing to pay up to $95 for the stock today. However, a person with expected return of 15% per year would be willing to pay up to $86 for the stock today. There is a non-exhausting list of reasons as to why people price the same stock differently. No one can predict with 100% accuracy the future price of a stock. Therefore, it would be better to be prudent in your own assumption, as it is better to underestimate than overestimate to avoid excessive loss in the stock market. Now, we will look at an actual graph that charts the revenue growth of a company over the years. What you will notice is that the company has been growing its revenue at around $30 billion per year. If you look at the growth by percentage, a $32 billion growth in revenue in year 2011 translates to a 48% growth in revenue year on year. However, a $31 billion in year 2020 translates only to a 7% growth year on year. If you do not take away anything from today's video, what I hope is that you at least gained a prudent mindset to not overestimate the growth of a company. While maintaining or increasing revenue growth is not entirely impossible, it is highly unlikely to maintain high growth in the long run. Once again, I would like to mention that it is better to underestimate than overestimate. An example of overestimation will be shown later in this video. And with that in mind, I will now explain the 7 factors that I use when analyzing a stock. The first factor is price to earning ratio. Why should you use PE ratio, you may ask? The reason is because it is the most common financial ratio that is used. When more people uses the same financial ratio, more people will agree on similar valuation, and therefore the more accurate your valuation will become. Also, this financial ratio will tell you the estimated number of years it will take to get back 100% of your investment, if the company gives 100% of their earnings back to their shareholders in dividends. If you are new to investing, dividend is the distribution of the income generated by the company to their shareholders. It is also one of the simplest financial ratio to calculate. The formula of PE ratio is price of share divided by earnings per share. You can easily extract these data from Yahoo Finance, after you search up the stock on Yahoo Finance. For all the example in today's video, I will be using a China stock listed in Hong Kong. Therefore, I will need to convert the earnings per share to Hong Kong dollars before computing the PE ratio. After conversion, the PE ratio of the stock is 6.5. What this means is that you will be able to get 100% of your investment back in 6.5 years, if the company were to distribute 100% of its earnings every year back to its shareholders, with the assumption that the earnings of the company will not grow or decline over the years. The lower the PE ratio, the more attractive a stock is. Of course, there are other factors affecting the PE ratio such as political risk, the debt that the company has, and the growth of the company's earnings. But generally, you can compare the PE ratio to the industry average to do a quick check to see if the stock is overvalued or undervalued. However, generally, I do not like to say that a stock is overvalued or undervalued. Instead, I would say that a certain amount of growth has been or has not been priced into the stock. It is also important to note if there is any irregular one-time income or expenses that may artificially increase or reduce the company earnings. An example of such thing is revaluation gain on investment. With that said, let's move on to the second factor. Growth. I will start with how to determine how much growth has been priced into the stock. The general assumption I make is that a stock will trade at PE of 16 in 5 years' time. The reason for this assumption is because PE of 16 will translate to a dividend of 6.25% or less. If the PE of the company is more than 16 in 5 years' time, I would rather buy a stock that give me 4 to 5% dividend today. In the future I intend to analyze dividend stocks. If you like my sharing so far, please help to click on the like and subscribe button. It will help me a lot. The second assumption would be that any stock with PE ratio of more than 16 today has some sort of growth priced into the stock. I would use the formula, current PE divided by future PE minus 1 to help me determine the implied growth over 5 years. Then I will fifth root the computed growth to compute the annual implied growth. So for this example, I assume that a stock is trading at PE of 28 and the future PE to be 16. After applying the formula I get to know that the implied growth is 11.84% per annum. At this point, if you think that the earnings growth of the company will not exceed 11.84%, you should stop analyzing the stock and find another stock, because 11.84% growth per annum has already been priced into the stock. You can also assume that the stock will trade at PE of 16 in 10 years' time. In this case you just have to 10th root the growth to find the implied annual growth over 10 years. But I am in the opinion that PE of 16 in 5 years' time is reasonable. I would not use this formula to calculate implied growth if I assume that the future PE will be higher than current PE. I would jump straight to calculate the expected gain. Again, I would like to remind my viewers by showing this chart to illustrate that it is difficult to maintain high growth over a period of 10 years. So for this stock listed in Hong Kong, the average PE ratio over the years is 12. And the industry ratio is 17.6. I will be using this information to calculate the expected return of the stock later. All this information are readily on the internet. 1 minute of your time, you will be able to find the industry PE and the stock PE through Google. The average earnings growth of the company is around 8% over the last 2 years. This information can be found in the income statement section of Yahoo Finance for any stocks. So what I would do now is to apply these assumptions I have. I will show you a few growth assumptions in my example, but personally I would select the growth assumption of 5% or less to be safe. I do not like to overestimate my growth, as the bigger the company gets the harder it will be for it to maintain the growth percent rate. So what I would do first is to compute the 5 years growth in earnings per share by compounding the assumed growth rate over 5 years. I will say EPS instead of earnings per share from this point of the video. I will then multiply the current actual EPS in the second column by the 5-year compounded growth in the third column. I will then get the estimated future EPS in 5 years' time in the fourth column. Assuming that stock will be trading at PE of 12 in 5 years' time, I will be able to estimate the future stock price by multiplying the future EPS in column 4 by the future PE, which is 12. I will then get my future PE, which is in my fifth column, and be able to compute the expected return of the stock in 5 years' time in the last column. Taking the first row as an example, the future price of the stock is 35.82 HKD and the current price of the stock is 18.40 HKD. This stock will give you an expected return of 95% return over 5 years if you assume a 1% earnings growth rate per annum. You will need to check whether the expected return of the stock meets your own expected return in the stock market before buying the stock. Take for example, your assumption of growth is 3%. If your expected return over 5 years is less than 115%, you can consider this stock. And if your expected over 5 years is more than 115%, then you may want to consider another stock. So, if you think that a future PE of 12 is too high, you can change it any number you want. Take for example 7, then you will have a totally different expected return and you will have to evaluate again whether the new lower expected return of the stock meets your expected return in the stock market. So how do you spot an overvalued stock? That is a question many will ask. You need to ask yourself if you are overpaying for growth. If your growth assumptions are too optimistic and is your assumption of future PE too optimistic. I have already gone through how to calculate the implied growth of the stock few minutes ago using this illustration. This is one way you can avoid overpaying for growth. Now I would like to illustrate what happens when you overestimate the growth of a stock. Taking the same stock from my previous example, I will adjust the growth to 25% and the share price today to 100 HKD and the future PE to 16. You would ask me if anyone would buy the stock at $100 if the EPS is 2.84. This would translate to 35.21 PE ratio. And I am sure that there are quite a few stocks that trades at this valuation today in the stock market. In the illustration, you can see that in 5 years' time you would have made a gain of 39% if you buy the stock at 100 HKD today and a potential 8.67% dividend at today's price. But what if the actual growth missed your growth assumption? You can look around you and see how many companies are able to grow at a 25% compounding rate over 5 years. I would guess the probability is less than 10%. Let's say the actual growth missed and the actual growth is 13%. 13% growth per year is in fact good in my personal opinion. In this case you would have made a loss of 16% and get a potential 5.24% dividend in 5 years' time, if you bought the stock at today's price. Now ask yourself this question: wouldn't it have been better if you bought a random stock that gives you 5% dividend today? So once again, I would like to caution my viewers to be prudent when estimating the future growth of a company. The larger the company, the harder it is for the company to maintain its high growth rate. The key takeaways you should have for the first half of this investing tutorial video is how to use PE ratio and why you should use it. How to calculate expected return by applying assumption of future PE ratio and growth rate. How to calculate the implied growth. And most importantly, the mindset to apply prudent growth assumption. If you like my sharing so far, please click on the like button for this video and subscribe to the channel. I would really appreciate it. You can also support me on Patreon. The Patreon link is in the video description below. You can support my channel contents and research with just $3 a month. And with $8 a month, less than 50 cents a day, you can have access to my Discord channel and ask me any questions there. I will also suggest one stock every month. This stock is exclusive to my Patreons in Discord. The stock used in the illustrations in this video is this month's suggested stock. With just another extra $4 more, you will get a short report including a simple financial forecast from me regarding the suggested stock. The reason why I only suggest one stock a month is because I value quality over quantity. With that, the first part of tutorial has ended. Remember to invest safely and logically. See you in the second part of my investing tutorial in my next video. Bye.